Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not-so-average financial advisor, all of my burning finance questions. And yes, this is my real dad. In this video, we're going to be going into detail on disability insurance and renter's insurance. We're going to cover all the basics so that you know all you need to know to create your own policies. So what does disability insurance cover?
Disability insurance is designed to cover a person's general living expenses in the event that they can't work. So think of it that way. Life insurance, you're dead and you're gone, right? I know. But disability insurance is for younger people, they're much less likely to die than they are to get disabled. So most of them don't think about this. But if you get disabled between now and age 65 and you can't pay your bills, what is the quality of life you're going to have, dependent upon somebody, I guess. So disability insurance covers those monthly expenses that you have if you're no longer able to work, or if you're partially not able to work, that kind of thing. Okay. So it's about meeting monthly expenses when some sort of a medical problem is keeping you from working. How is a disability defined? Well, that varies by policy. Some of them define it as a loss of income. So you had this much money per month, now you have one half that much money per month after your disability, so they pay half of the money, or they pay a large portion of half of the money. Others are defined by your actual occupation, for example. So if you're a surgeon, let's say, and suddenly you can no longer be a surgeon, but maybe you could teach at medical school. You could teach surgery at medical school. You might be fully disabled if the definition is you be a surgeon. If it's by your occupation that you be a surgeon. So you, in theory, might be able to double collect under a policy like that. Some policies are you have to be just fully and completely disabled, like Social Security. The definition of disability to get a Social Security benefit is you just have to be fully and totally disabled, unable to work in any capacity whatsoever. So you have different definitions and different costs of the policies based upon which definition you're purchasing. Interesting. Because in my head, I was imagining you'd have like a doctor's note or some sort of like proof that you've seen a medical specialist who... And you would absolutely need all of that. The insurance company might even put you through their own medical specialists to make sure they believe that you're disabled. Yeah, because I'm sure they want proof. How do payments work for disability insurance? Well, it's very similar. You can have a monthly payment or a quarterly payment or less frequently even if you'd like to. Most people get their disability insurance through their employer. So usually it's just deducted right out of your salary. Even if you can't work for that employer anymore? Or how? Well, if you become disabled, you no longer have to pay the premium. That's called a waiver of premium. Usually it's set up that way. So it's called a waiver of premium if you become disabled. You don't have to keep paying for it. You or your company starts paying into it. If the event happens where you become disabled, then you don't have to pay the premium anymore. You receive the benefits. That's precisely correct. There you go. There you go. You're ready to be an insurance person. You're ready. So I might have just actually gone over that, but I've heard of the term waiting period before. Okay. I'm wondering what that is. Well, okay, think about a disability. Sometimes people get hurt and they can't work for a little while. It might be a couple of weeks or something as they're kind of sort of coming back to work, a broken leg for somebody who works in a physical job, let's say, something like that. So it might take a few weeks, but they're going to come back to work and they're going to be perfectly fine. If you had disability insurance for that, it would be very, very expensive because that's a pretty likely, that kind of thing happens much more frequently, okay? The kind of disability that this is intended to protect you against is one that is going to last the rest of your life, usually, okay? And as a result of that, they have what's called a waiting period. The waiting period might be 6 months. It might be a year. So you have to be disabled for that long before the insurance benefit starts to kick in. Usually then, though, the benefit goes until you're 65 years old.
Okay.
It may also go up with inflation every year if you've purchased that kind of insurance that can do that. So it's close to where you used to be financially until you hit the age of 65. So by having a waiting period that's longer than 3 days or something like that, it reduces the cost of the insurance because it's that much less likely that you're going to actually need the insurance. But if you do need the insurance, if you need it for a catastrophic situation, a very bad situation, you will have it.
Yeah. Okay. That makes total sense to me, actually. So then, in that case, a policy would last your whole life.
Well, at least to 65. Generally speaking, they will pay you until you're 65 years old. So, if you're very young and you haven't saved much money between, the start of your career and a time of a disability, that would be problematic when you get to be 65 and there's nothing there. But that's a separate problem that you have to deal with. But they don't pay for life typically.
Gotcha. Let's talk about renter's insurance.
Okay.
So what does that typically cover?
Okay. Well, first, renter's insurance is for if you are renting a property. You don't own a home. You're just renting someplace, okay? There are risks that things might happen. So, for example, what if you're having a party and somehow a fire starts and you burn the place up and there's a lot of damage from a fire? That would not be good. What if there's water damage to the apartment from some sort of a flood and you have clothing and you have furniture that you've brought in and televisions, whatever it may be, all of those kinds of things. What if somebody gets hurt in the apartment while they're there with you? So this renter's insurance is designed to protect a renter from the money that would be needed to pay in the event one of these things happened. If you need to replace your property in it because of a flood or a fire, something like that. If you've damaged the building somehow, if somebody got hurt somehow. And then finally, it typically will also pay for you to live somewhere else while your place of living gets fixed up. So because if you can't be in it, if there's a fire or something like that, it will pay you someplace so you can live someplace while you're getting everything set up to be able to get back to where you were.
And now, how does payment for that typically work? Is it similar?
Very similar. Probably what I've seen with those is typically it's a little bit more like a quarterly kind of a payment than a monthly payment, but it varies by company, and it's paid by the renter in basically all cases. Okay.
Question that might actually not relate to either of these kinds of insurance, but I'm going to ask it anyways. What is a cancelable or non-renewable policy?
So most insurance contracts are, many insurance contracts are a unilateral contract, meaning that the policyholder has the right to decide when and if that contract is canceled. So, for example, a life insurance policy. If you buy a life insurance policy and you're paying your premiums for years and years and years, and now suddenly you get cancer or something like that, and your life is at risk, well, if the insurance company could simply cancel your life insurance because they find out that you got cancer, then you've put all that money into it, but when you pass away, if the insurance policy isn't there, you don't get the benefit of all the money you put in already. And that wouldn't be fair to the policyholder. So some kinds of policies are non-cancelable. Some are cancelable. A health insurance policy, for example, is typically cancelable, meaning the insurance company can decide that they no longer want to insure you or insure your company or whatever it might be. So disability insurances, what you want is a disability insurance that is non-cancelable, so that you don't have to worry about a disabling event happening, and during that waiting period, during that 3 months, 6 months, or a year, the insurance company cancels it on you. Now, the insurance company always has the right to cancel on you if you don't pay your premium. But if you have a non-cancelable coverage, they can't cancel it on you simply because the likelihood of a claim has dramatically increased, which is really what we're talking about here. So that's what that's about.
Okay. And on the waiting period, are you still paying your monthly premium during that period while you're waiting to see if you'll need the policy?
I think that varies by policy and whether or not you've chosen an option for it to stop paying the premium upon a disabling event as opposed to upon receiving a benefit.
All right, well, that concludes this installment of our insurance videos. Make sure to tune into the next where we talk all about life insurance. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.